Good evening, everybody. It's February 2nd, 2021. And with everything that's been going on in the last week or so in the markets, we thought it was important to reach out and discuss last week's market decline and the impact of President Biden's executive orders now on your investment portfolio. Has SFA's investment outlook changed? That's a question we're getting a lot. So why did the market decline last week? And how did the overwhelming press given that decline affect it generally? The chart on your screen now shows the main offender in a battle between professional hedge fund managers who were betting that a company called GameStop would go down in value, and they would make money from that decline by selling shares they didn't own and buying them back later and replacing the sold shares at a cheaper price. This is called short selling. We've rarely employed it on special occasions, let's say. And it was working until a young investor group on Reddit decided that they would beat the older guys at their own game, and I truly believe took their stimulus dollars and made small purchases of options on GameStop. And you know, when you buy call options, the market maker has to go out and actually buy the shares and hold them in inventory. Well, this caused a tug of war, and that tug of war was being lost early on by the hedge fund managers, and the Reddit guys were winning. So you see here, going back to January 25th, which was Monday, on the blue lines, the GameStop actual returns on a daily basis. The orange is the S&P 500 return for the same day. You'll note that this week, as we predicted last week in a social media comment that was posted on our websites, GameStop is losing everything that it had gained. This is not a strategy that wins long term. There are going to be winners and losers here. Some of the people who bought the stock, fighting the hedge fund guys who were driving it down in price, may be able to get out and make some money. This caused a lot of nervousness, and it was really for naught. If you look to the right of the screen, you see the box that says value of a $10,000 initial investment. So $10,000 at the end of trading on 1/24, and one day later, excuse me, you're up to $11,812. It climbs until you get to Wednesday, and then it has a steep decline Thursday to $29,000. In a $10,000 investment valued at $13,451. That figure will not hold. It will decline, and I believe it will go well below the $10,000 level. GameStop's fundamentals, in our analysis, don't look good. Not a company you'd want to own, but it did create a lot of, I don't know whether to call it panic, a lot of concern in the markets, and even with my clients. So that's the GameStop issue, and it is over. President Biden's also brought up questions from our clients due to the more than 40 now, I believe it's 42, executive orders that he's issued. I've looked at every single one of these orders in detail for influence or effect on your portfolio. There's a lot of things I can say about it, but financially, remember, executive orders are used, folks, because you can't get legislation through the House and Senate. This president comes in with the thinnest majority in the House in recent history and a razor-thin edge in the Senate, where he's tied 50-50 with Vice President Harris breaking any tie votes. Most of his orders are social issue things. In my opinion, they're a prescription for more racial animus, dividing us up into tribes, higher utility and gas costs, and I do think gas, electricity, they're going to go up 50% probably between now and the end of the year, could be more. That's a function of the Keystone XL pipeline and other executive orders that vastly affect our nation's proven energy reserves. Higher manufacturing expenses, of course, will result Because in the manufacturing business, energy is your single largest cost. Due to job losses, or at least the lack of gains in the U.S., and significant job gains to overseas competitors, including China and Russia. Russia sells a lot of natural gas. We're throttling back. These executive orders are going to reduce our economic growth somewhat, probably not so much this year, but as they go into effect next year. As we've mentioned in several social media posts and videos, but we believe the equity market's likely to perform exceptionally well. What am I basing that on? Well, we could use the model of ex-President Obama's problematic 8 years. His first year, the S&P increased 23.45%. He had a huge majority, a supermajority in the House, and a large majority of 6 seats in the 100-seat Senate. He couldn't get much legislation passed. He got a couple of problematic bills through early on with his stimulus package. His efforts went for naught after that. And at the midterms, less than 2 years later, the House and Senate went overwhelmingly conservative. In that first highly problematic year for President Obama, coming out of the third worst recession in our country's history, and the one we just had isn't close, I said the market went up almost 23.5%. SFA accounts went up 46.82%. The tactics are predictable. I'm going to do the same thing that we did then. We're going to use our concentrated and predictive methodology to put our money in front of events that are likely to occur. I believe we'll be successful. We need to follow the money, though, on these executive orders. They're remarkably similar to orders that were issued at the beginning of the 2009 Obama presidency, and therefore will have predictable and likely similar dismal economic results. And we didn't have a bad economy during the 2 terms of President Obama. We just had a stagnant economy. Average growth of domestic product of 1.6% a year. Job growth was stagnant, etc. That's the result of policy. And these policies are designed to slow job growth and economic growth. Despite that slowing, these policies are going to likely create a 20 to 30% increase in our specific value-oriented higher dividend portfolios that we have weighted towards economic reopening and economic reopening themes. You know, there's many hidden consumer taxes that are already being imposed. Those are caused by gas prices and oil and electricity going up in cost. You could consider that a direct tax. It was certainly implemented by these executive orders. We believe oil will rise to approximately $80 a barrel this year from the current $54. Gas will go up a little more percentage-wise. Excuse me. According to the U.S. Bureau of Labor Statistics, wind and solar jobs in the U.S. are supposed to grow over the next 10 years by 10,400 jobs. Now, that's the U.S. Bureau of Labor Statistics for estimated growth. That growth is going to be created by destroying the jobs of over 40,000 coal miners, many of whom will likely lose their homes, their livelihoods, and in some cases, their families. That's done by executive order. Is that a moral trade-off? I don't think so. Going back to the situation with GameStop, what we call a short squeeze that we saw, the SEC issued a statement, as we predicted they would, looking at market manipulation and warning participants that they would take action if they needed to. That's one of the reasons that GameStop is under control and the markets are recovering handily today and yesterday. This should continue to eliminate any intermediate or long-term issues. So all the executive orders, the GameStop issue being resolved, and the political fallout that's happening right now from trying to act as a super legislator, as a president, should lead to a resounding takeback of the House and the Senate in 2022 by conservatives, just as it did in the midterms of President Obama's first term. There's also going to be a lot more friction within the Democrat caucus between ultra-left liberal socialists and more conservative or traditional Democrats. Therefore, we believe strongly, and this is important for your portfolio, that substantive legislation that could enact long-term changes will be almost impossible through this first term. That's going to be worsened by the very likely outcome of the midterm elections. Now, who should our country be helping now? Because we've got another stimulus package coming out, and we believe that stimulus package, even though it's wasted, in all likelihood, is going to have a net positive economic effect and an extremely strong, highly positive effect on the value of your portfolio. Well, we need to help those who actually lost their employment first off. More than half of us didn't lose any income. You can include all government workers in that, federal, state, and local. But many small companies are hanging on a thread in retail and food services, etc. You shouldn't send checks to employed people that are simply going to be deposited in savings accounts, or to folks collecting enhanced unemployment that provides them more income than their job did. I heard on the news this morning one of our U.S. senators speaking, and he announced he'd gone home and his wife handed him his stimulus check. Now, I'd have to look it up, but I think he makes about $191,000 a year. He didn't need that stimulus. People up to $250,000 of income are going to receive this round, not previous rounds under President Trump. Too much stimulus over the past year has also caused savings accounts to increase. Stimulus in the wrong hands, I should say, going to people who didn't need it, has caused savings accounts to actually increase in our country by $1.6 trillion. That's a lot of money. That's since March of 2020. Now, if people are depositing almost $2 trillion in their savings account, that tells you they were being paid and they simply didn't need the money. Most estimates, Bureau of Labor Statistics estimates, Treasury estimates, would say that no income has been lost by approximately 2/3 of the working population. The other third has literally been decimated income-wise. Those are your small business owners, your restaurant workers, your service teams that have struggled because they're either closed down by government or can't find work, and they do deserve and need our help. We need to be providing this aid to people who actually need it, not sending, as per President Biden's recommended stimulus plan of $1.9 trillion, $350 billion to extremely poorly run blue state governments to bail them out from their decades-long overly generous pension plans. We should also not establish a $15 minimum wage that will throw millions of kids, new entrants to the workforce, and low-income Americans out of work. We've seen this everywhere the minimum wage has been hiked. For example, if you own a fast food store and you go from $12 to $15, that's all you need to have the logical conclusion of buying automated equipment to deliver up your hamburgers. That will eliminate jobs, unquestionably. That's Econ 101. Those earning up to $250,000 I mentioned previously are actually eligible under Biden's plan for stimulus dollars. But folks, get this. So are illegal aliens, and those are in our country who don't have a Social Security number. You know, this is important. It's near and dear to my heart. My first job at 11 and 12, I worked 12 hours a day on Saturday and Sunday at the First Kentucky Fried Chicken in Lexington, Kentucky, over near Eastland Bowling Alley. And that was my most important job. I was working next to men in the kitchen and outside, and I learned a lot. And yeah, it was off the books. I wasn't there legally, but I needed the money. And I learned more from that job about showing up and working hard and focusing and following instructions and coming to work on time than anywhere I've ever been since. Kids need that experience. Minimum wage jobs are made for new job entrants, primarily our children. and they're not made to be a career. Raising the minimum wage artificially, not required by the market, reduces the number of jobs. If it's going to go up, it'll go up naturally. By the way, giving money to folks that don't need it, which is where I believe those Reddit kids got their money to do this trading and thereby disrupt our entire equity market, is not a good idea. I believe that there are hundreds of billions still left over now from the $900 billion package of stimulus that was passed just 2 months ago in December. Now that's really similar to ex-President Barack Obama's presidency, because when he walked into office, he had half of the 2008 stimulus package passed by President Bush and that Congress left to spend. Bush left it for him, said he was going to on December 15th of 2008. That was $375 billion. Not one dime of it had been allocated or spent. I believe President Bush left it to him because he didn't think he would need it, and he knew he didn't need it in 2008. Well, President Obama still pushed through a $900 billion package. Now it's $1.9 trillion. And the recession officially was declared over 5 months after he took office, and before the first of that $900 billion of stimulus ever got out the door. It didn't stimulate much, which we predicted in a letter we wrote you in March of 2009. But when asked about it years later, President Obama laughed and said, well, it turns out there weren't that many shovel-ready jobs available after all. Most of it went to raises for federal employees. In terms of executive orders and President Biden's agenda, it's almost impossible he's going to get his full agenda through. Now, he can nip at the margins, the societal margins, with his executive orders, which is why he's done 4 times as many as President Trump in this short period. But it's literally giving stimulus to rich people and to illegal aliens who committed a felony when they came in our country and are already taking jobs at lower pay, thereby artificially depressing pay of Americans from Americans. These policies are literally designed to put Americans out of work, especially in the oil, gas, steel, and food industries. This plan hurts the very people it's supposed to help. This giant stimulus bill mainly provides relief to Democrats who are hoping to keep the House and Senate in 2022 by pouring out cash to voters, both employed and unemployed, even as the economy is clearly, and as we predicted in March, already in a sharp rebound. Let's take a look at a long-term lesson that is so important. And I mention this lesson because I've had a couple of calls today with wonderful clients, wonderful people who are concerned. And we're going to talk about one subject of their concern, which is our GE option strategy, in just a second. But they're also concerned about the market. They're concerned about factors affecting the market that could harm them permanently financially. And so once again, we turn to our Ibbotson chart. And we look over a very long time, starting with the Great Recession, where things really went to heck in a handbasket, including every recession and downturn that we've had since that time, shown in the shaded areas. You notice they happen frequently, every 3 or 4 years. Every time a downturn's occurred, 100% of the time, our capitalist markets where supply and demand set the rules of the road, have bounced back. And 100% of the time, they've risen to new highs. Over that long period of time, or 30 years, or 20 years, or 10 years, the numbers are remarkably consistent with the compound annual returns you see on the right-hand side of your screen. Small stocks have tended to return 11.8%. Large stocks, that would be the S&P 500 index, a little lower, 10%. Long-term government bonds, 30-year bonds, 5.5%. Treasury bills, 3.3%. And that barely beat inflation during that time at 2.9%. You see another view of this here in the 10-year daily chart. Far left, you see the decline that occurred in 2008, 2009. We sold about halfway through that decline, saved our clients a downside. But the reason I sold, and I want to say this clearly, was because I believed it was a recession. Our rule here is we sell in recessionary events. We don't sell in glitch events. Example of a glitch event would be the fourth quarter of 2018, where we told our clients that was a technical correction. There was a lot of discussion of recession. We saw zero signs of it. That led to the outstanding returns that you experienced in 2019, and the market recovered quickly. Another glitch event, in my opinion, is COVID. COVID's a glitch event because it was a self-induced recession. Politicians decided to shut down businesses, schools, and our lives, in my opinion, highly unconstitutionally, and that led to a debacle in our economy and has led to far more murders, drug overdoses, drunk driving, spousal abuse, child abuse, and untold wrecks of our educational system and our children's futures than we could ever possibly measure. But once the numbers come in, that glitch event, holding through it, as you see far right side, resulted in what we predicted several times in writing, and that was a V-shaped recovery. Our firm is forecasting that the equity market low has already been reached, and that was last week. This month, we believe we're going to see a rapid, widespread reopening of the economy, and it's going to occur at an increasing rate. A lot of things will be in motion to open state economies individually. And you know, other nations are also working in tandem to open theirs. There's a lot of anecdotal evidence about this. I don't know if you guys saw Mayor Lori Lightfoot up in Chicago, is in a big fight with Chicago school teachers unions, trying to get them to do what CDC says is absolutely perfectly safe. Put our children back in school. That's a pretty good piece of anecdotal evidence, because Mayor Lightfoot is about as liberal as she can possibly be and has sided with unions her entire life. New York restaurants are reopening. Never thought we'd see that. Regional stay-home orders are rescinded in California. Politicians have now decided that COVID is almost over, even though more people are dying daily. What they've probably realized is the election's over. And they're also realizing that deaths are going to occur in a pandemic. Keeping the most vulnerable among us safe, that's the elderly, and our children in terms of their education, because COVID doesn't touch them. That's what we should be doing in the next one. Goldman Sachs also just increased their estimate from 4% all the way up to 6% for gross domestic product growth this year. That means the economy going up a total of 6%. We hadn't had a 3% year until the one that started in President Trump's last year. We hadn't had one in over 20 years before that. We're going to see 6% year this year, I believe, or maybe a little higher. And then I think it'll cool unless we can get to the midterms and stop some of these nonsensical, socially driven policies that are destroying people's ability to earn a living. What really drives this is these huge stimulus packages. But folks, it's not just domestic. The same thing we're doing here is relatively close to what the European Union's doing throughout Europe. It's what China's done. It's what Russia's done. They're literally dumping money into their economies at a whirlwind pace. And what does that affect mostly? Equities. And it raises their prices. What does it hurt? Bonds. Bond prices are declining. The 10-year Treasury is rising. The 10-year Treasury yield is rising. That reduces the value of that bond. That rise, that long-term interest rate rise, it is absolutely baked into the cake. And when interest rates move, they move in 20 to 30-year trends. So we avoid bonds. We choose high-quality, undervalued equities. Central banks, treasuries, they're doing the same thing. They're throwing money at their economies, and that is an absolute prescription for future high inflation and interest rates. For that reason, folks, beginning last April and continuing through this year, we have rotated out of growth equities and into value equity styles. That hurt us a little bit at the end of last year, particularly with our banks. But as you'll note today, when you look at your banks and they're up 3.5%, there's a tremendous valuation disparity. And we believe that's going to resolve soon with banks moving at a rate well above our portfolio estimated return of 20 to 30%. Here's one of the reasons I say that. The blue line is value stocks. The orange line is growth stocks. This is an index. So the growth stock line only has growth stocks. Value stocks are the only thing in the blue line. This is the last year. Notice the fall, the market fall that occurred through most of March. And they moved pretty much in lockstep. They deviated a little bit, but not much. But since that time, they deviated a lot. And go to the right-hand side of the chart, value stocks were penalized. Over that 1 year, they've only appreciated 4.73%. But growth stocks appreciated 37.9%. So there's an over 34% performance difference. Remember that for a second. If you look at it over 18 months, the difference is larger. Now you're looking at 45% approximately. We go to 2 years, it's larger. We're looking at over 58.5% of performance differential. 3 years, it's even larger. We're looking at almost 62% of performance differential. This is historic, folks. It can't last. It never has. And I can tell you why it's occurred. It's occurred because the FANG stocks, Facebook, Amazon, Netflix, Google, plus Tesla, so about 6 companies, now make up almost 25% of the S&P 500 index's weighted portfolio. Those are the stocks that people turned to during the pandemic when the economy was being burned down by our politicians, when they wouldn't let people work, even those who could safely work. And because of that, those stocks have risen to what I believe are catastrophic levels. I would not touch any of them. They're going to look like GameStop over the last week. They'll look like that over the next year. They must decline. Their valuations are not just extreme, they're obscene. And what will happen with our value stocks is these lines will cross again. Value on the way up, growth on the way down. Value portfolios simply are likely to substantially outperform this year. Our bank sector especially is going to thrive, as they're going to get a lot of help from the Federal Reserve and the U.S. Treasury, because this government really needs their help if they have any chance to win seats in the 2022 midterm election. So the likely outcome of all this, financially, economically, politically, from your investment account situation, we're going to do great. Economically, we're going to have economic stagnation from the 6% rate we're likely to see this year. Politically, we're going to likely see a huge conservative victory in the House and the Senate in the 2022 midterm. We've already seen a precursor to that, because in the midterm, in the president's election, we should have lost seats. We always have. The party in the president's office loses seats in the House and Senate going into the second election. Nancy Pelosi said that they would win 30 to 40 seats. They lost 22 seats. Their margin's very slim. That forecasts a much larger move, I believe, in the 2022 midterm. There's going to be a lot of difficulty in President Biden getting any of his harmful legislative agenda through. And I'll be honest with you folks, I don't understand all the angst about this. We've seen this before. People were scared of President Obama's agenda. It was difficult for him when he controlled both houses, and none of his changes were permanent because we took it back. We don't buy initial public offerings because they're artificially supported in price, and when that artificial support comes off, that's why the initial blip up gets washed out. I don't ever want to be left holding that bag in your accounts. I was also asked about our GE option last week. Last week we made a very superb call on GE's earnings announcement. I had done a lot of research on it. I felt the earnings announcement would be at or above consensus estimate, and I felt the stock would move strongly. We bought a GE call option that was very short term. It was going to expire in 5 days. I did that because that was going to give us the most bang for our buck. This is a strategy I've employed before with great success. My predicted conclusion of the earnings report was correct, and GE initially jumped out of the starting gate. Our operations manager, Jacob Buckley, and I began working on a sale. Before we could get the sale done through the trade desk at an adequate price, we found on Tuesday that the Game Boy situation was slamming the market. That took GE's stock price down and the options price. We elected, rather than to sell at a loss, to hold that option through Friday's close with the anticipation that the SEC would step in, as they've always done with these Game Boy type situations, and stop trading or deal with the situation directly. They did not do that until late Friday. So the GE option did expire worthless. I want to mention that while that was a loss in the accounts, relatively close to that time, we had a short-term trade with UPRO that had a much larger gain. Just like in basketball, if you don't shoot, you're not going to win. So GE option was a loss because of the broad market activity that was taking place due to the hedge fund fight with the Reddit boys. In conclusion, we believe the market low has already occurred for the year. We also believe the economy is going to fully reopen within the next couple of months, ending all COVID-19 inducing market issues. Because of what we own, that's going to give us some strong upside price pressure. We want you to understand that there is a model for what's happening now, and that was President Obama's administration. And the results during his 8 years were absolutely great for our clients. We were up 141.9% in that 8-year period. Democrats generally help the equity market more than they hurt it because they spend more government money and pressure the Federal Reserve for looser monetary policies. This causes equities to rise. And I think I'm being handed a couple of questions here. Will the pipeline decision cause stress between the U.S. and Canada and affect the markets? No, and I'll tell you why it won't. So the Prime Minister of Canada, Prime Minister Trudeau, is very happy, unfortunately, not to have to deal with someone that has an America First policy. So he's already recognized publicly that this is a hit to Canada, that pipeline's been stopped because the agreements were in place to sell that natural gas immediately. But it doesn't mean they don't sell it. It's a small hit. They'll stick it in trucks that have tremendous carbon emissions. They'll stick it in one of President Biden's biggest donors' railroad cars. That's Berkshire Hathaway and Warren Buffett, who gave him millions for his campaign. And they will truck it down, and they will bring it down on Burlington Northern Railroad, owned by Berkshire Hathaway and Warren Buffett, with tremendous damage to our environment and carbon emissions. That doesn't make any sense, but you see the Canadians don't lose much. What they gain is they gain someone that doesn't put America first and won't pressure them on unfair trade agreements like President Trump did. So I don't think it's going to affect the relationship at all. It probably will make it a little more jovial, but certainly not as advantageous or fair to the American people. And it will not affect the markets other than one more nail in the coffin of what is truly energy independence, and also raising our price for energy all the way across the board, both in manufacturing, at the gas pump, and in our utility bill. Remember, guys, we've already got lawsuits being filed both by states and individual companies on these lawsuits, including Keystone XL. including the ripping away of the federal oil leases offshore. That's been stopped by a federal circuit court judge for 180 days. I think there'll be more to come on that. There's been a lot of overstepping there. Don't think those battles are over. They're just beginning. Another question that I've been given is, why did the Fed say they were keeping interest rates low without even mentioning inflation? Boy, that's a great question. So if you look at modern economics, there is a school of thought, believe it or not, because it makes no common sense, therefore it shouldn't make academic sense. There is a school of thought that the U.S. Treasury and the Fed could just spend money and give everybody guaranteed income. That's like the socialist pipe dream of the century. But I've seen major economists buy into it, or maybe I should say they were bought into it. The Fed's kind of done the same thing. The Fed's a little scared and has been really since 2012-13. They used a lot of policy tools to keep rates artificially low. For the 8+ years, they did keep rates at zero prior to the rise that's now been reversed, and we're back at zero again. The Fed has set an inflation target which is 2% plus. So until they see inflation at 2%, which I think will happen probably prior to the third quarter, or at least sometime in the third quarter this year, you can anticipate rates will stay low. Fed's statement a couple of meetings ago said they would stay low through 2022, the end of 2022. That's not going to happen. The Fed will change their statement, as they have about 1 million times, based on the current conditions. So rates are low now because the Fed's a little nervous. They're running out of policy tools. They are aligned with the views of the Biden administration. And remember, Janet Yellen, our new U.S. Treasury Secretary, was, for a long time, the Federal Reserve Chairwoman. So she will work as close with the Federal Reserve Chairman as they have ever worked between Treasury and the chair. She will influence it. She is an easy monetary policy, low interest rate person. If she had her way, whether inflation was high or not, rates would stay low. But I believe rates will have to be raised once we start getting some traction in the inflation department. Any other questions, guys? All right. If you do have other questions, please either give us a call, leave a voicemail, send us an email, call me on my cell, and we'll be glad to address them. I want to close like this. I'm very confident. I'm as confident as I've ever been in my career. And I know there's a lot of nerves out there. And I wish I could fix that. I wish that when you go through a week like we went through last week, when I was absolutely certain of the outcome, that you had my certainty. We're not going to fail you. And remember where I said I'd sell. If it's a recession, which is a longer term, deeper downturn, we're going to sell, and we'll do it well before the R word is used, recession. If it's a glitch event, we know what happens with glitch events. You get sharp bounce backs. That's why it's a little easier perhaps for our firm to predict it. We're students of economic history. We're not going to leave you out to dry. The only person that should be worried in a retirement situation or pre-retirement about their portfolio right now would be someone that's distributing above 7 to 8% annually. You could be in trouble because of decline. But if you're down at the 4 or the 5 or the 6% level, you can handle a decline like we saw last year, and you'll bounce back. And you can have certainty. And if you want to, pull up that Ibbotson chart on Google and look at it. Think about all the disasters that happened. The market has a 100% track record of success, and we're going to follow that record. God bless you and your families. Hope everybody's well at your home. Appreciate your time. Have a good night.